Welcome back. I'm Jason Rinaldo. As we step into 2026, I want to take some time to reflect on what was truly an extraordinary year in the markets. There's a quote from Eleanor Roosevelt that keeps coming to mind. Today is the oldest you've ever been and the youngest you'll ever be. And I think that captures where we stand right now. We've got 3 years of a bull market behind us, but we're also standing at the beginning of 2026 with everything still ahead of us. So let's dig into what happened in 2025 and what it might mean going forward. Let me start with the headline number. The S&P 500 stock market index finished 2025 up 17%. Now that's a third year in a row of double-digit gains, which is impressive. But here's what makes 2025 special, how we got there. The market plunged 19% in the first part of 2025. Think about that. We're talking about one of the worst starts to a year in modern market history. The catalyst is attributed to a broad-based tariff implementation. In just a few weeks, investors watched a portion of their portfolio evaporate. Here's one observation about financial markets I'd like you to take away. Since 1980, the stock market on average has experienced an intra-year decline of 14%. However, still finished the year positive, a remarkable 76% of the time. Stated another way, declines commonly occur for a variety of reasons, yet the stock market still finished positive most of the time. This is exactly why we emphasize bucket-based investing and long-term thinking. The worst days and the best days in markets often come close together, and you can't predict which is which in the moment. One of the things we've been talking about for the last couple of years is market concentration. The Magnificent Seven stocks dominated in 2023 and 2024, but in 25 gave us the first real signs of broadening. Only 2 of the Mag 7 companies, Alphabet and NVIDIA, actually outperformed the S&P 500 in 2025. Meanwhile, all 11 sectors posted gains. What does this tell us? It tells us that returns are starting to come from a wider variety of sources. That's rising breadth, and it's healthy for markets. Now let's talk about something that really surprised a lot of people, international markets. For years, U.S. stocks have been the undisputed leader. But in 2025, international stocks took center stage. Emerging markets posted a 33% gain. The United Kingdom and Japan each returned over 25%. Why did this happen? Several factors come together. International stocks started the year from a lower, more attractive valuation point. The US dollar also weakened, which benefits foreign stocks when you're a dollar-based investor. Looking ahead, Europe is ramping up government spending. Asia continues to innovate in AI, and emerging market central banks have kept monetary policy accommodative. These factors, we believe, will allow earnings to accelerate. This is a reminder that diversifying globally isn't just about managing risk, it's about capturing opportunities that don't always show up in U.S. markets. The bond market had a much better year in 2025. The Bloomberg Aggregate Index returned over 7%, the best year for bonds since 2020. The Federal Reserve helped by cutting rates 3 times in the second half of the year, bringing the federal funds rate down to 3.75%, benefiting bond prices broadly. This was a welcome change after the challenging environment for bonds in 2022 and 2023. Now, there are some cross currents. Long-term interest rates actually went up, prices down, despite the Fed cutting short-term interest rates. This was, we believe, due to concerns about government borrowing and inflation. Importantly, bonds can provide portfolio income, but we need to be thoughtful about where we're getting that income in terms of short-term versus long-term bonds. I can't talk about last year without mentioning precious metals because their performance was truly polished. Gold rallied 65%, its best year in decades. Central banks around the world were buying, retail investors were buying, and the dollar weakness after April added fuel. These factors could persist into 2026. But silver was up even more, a spectacular 160% for the year. Silver has a unique position in the AI infrastructure buildout. It's a key component in data centers, electric vehicles, and solar panels. So it's benefiting from both precious metals demand and technology transition. So where does this leave us for 2026? We've got broader market participation, international markets showing strength, and a relatively healthy bond market environment. Corporate earnings are expected to grow double digits again in 2026. Now, valuations are stretched within certain market segments. We're at levels we haven't seen since the dot-com era. That doesn't mean the markets can't go higher, but it does mean that stock performance will likely depend more on earnings growth than multiple expansion. Importantly, we've got Fed policy uncertainty with a new Fed chair coming in May, while tariff policy remains front and center. The key is that we don't try to predict which way these factors will play out. Instead, we position portfolios to handle a range of outcomes. Our approach remains unchanged because it's built on principles that work across different market environments. Disciplined diversification, thoughtful rebalancing, focus on the fundamentals, and alignment between your financial plan and the investment strategy. Thanks for tuning in. As always, if you have any questions, please reach out. We're here to help.
All content discussed in our podcasts, videos, or related blog articles are for informational purposes and should not be construed as individualized financial advice. Opinions expressed herein are solely those of Vector Wealth Management, our staff, and guests. Material presented is believed to be from reliable sources. However, we make no representations as to its accuracy or completeness. All information and ideas should be discussed directly and in detail with your financial advisor prior to implementation of a strategy or investment.